Welcome everyone. Bonjour à tous. My name is Christophe Viarno. I'm the founder and CEO of Africa Arena. And I'm so thrilled to be with you today for the launch of the digital collective Africa, which is an amazing initiative that we're going to discuss for the next hour and a half. So we're going to have an initial presentation about what the collective is. Then where we're going to talk about the goals and how the collective was born. Then Valentin from the Africa Arena team is going to talk to us about the website of the collective, which we are launching today, and what it contains in terms of resources. Subsequent to this, we will have the amazing Julia Price from Endeavor giving us a presentation about the first key deliverable as part of this first version of the collective, which is the term sheet template, which is the result of several months of work of the collective. Then in a second moment, we will have a panel discussion with amazing minds. So we have a fantastic lineup of people on the panel. So we will have Julia, obviously, from Endeavor, Angela Muraguri, who is from Kawisari Venture, Matthew Marshall from Partech Africa, Ross Janevy from Kingston, and Sharon Ahmad as the entrepreneur. The panel will be moderated by Mark. Mark will reintroduce the panelists later, so you know more in detail who they are. But let's start with why are we here? So, you know, the collective is an amazing alliance of people ranging from founders of tech startups across the continents, investors, angels, VC, institutional investors, whether they are fund of funds or DFI, and ecosystem players. So we have many incubators, accelerators in the alliance. The project is supported by all major investment network on the continent. And so we are very happy to be here today to talk to you about what we're going to do and why we're doing it. So the project was born at the Africa Arena VC Unconference last year, which was an unconference format between investors talking about how can we foster investment on the continent. And next slide, Valentin. The realization of the people that you see on these slides, which are some of them that were present at this conference, is that, you know, VC is a long play, and VC is a lot about deal syndication and co-investment, and you know, Africa is a very early stage ecosystem at large, and there is still a lot of work that needs to be done to facilitate transaction and to make sure that there are more deals that happen. So the main key pillars that, you know, we sort of agreed upon as a collective then at the unconference, and then many people came on board this initiative, was about harmonizing the investment practice and document across the stages and geographies in Africa, to limit frictions between investors and entrepreneurs, deal instruments. And so that talks about things like term sheet, obviously, but also things like you know, due diligence approach and other stuff. The second reason is that, you know, we want to enable deal syndication between investors, so that, you know, there is a transactional output to this work. It needs to result in easier, faster deals and more international investors coming because they can do co-investment with local investors. Then the third thing is really about knowledge, sharing knowledge and insights. So you'll see on the collective website a list of investors, list of incubators. There's a lot of knowledge documents. Most of the key reports about African VC investment are in there. So it's really a one-stop shop for you to find all the useful information when you want to learn about VC in Africa. And finally, the fourth point is to lobby towards you know, facilitating regulation that are friendly to tech founders. We know about Startup Act in Tunisia. There's been one in Senegal now at the end of last year, discussion in South Africa and many other countries. As a collective, we want to join forces to lobby for more progressive regulation and facilitate the job of investors and founders when they're trying to create economic value and jobs for the continent. So now, specifically, what are we doing? Well, you'll see on the website that there's a library of standardized documents which are designed as an open source, so everyone can download it and obviously change them. We're not trying to standardize transaction. We're trying to provide tools to facilitate transaction. And so the first of which is the output from all the work done by Endeavor with the collective. The second element is we provide and curate useful reports and insights for you to have more knowledge about tech ecosystem in Africa. We offered transparency on resources available, as I mentioned, in terms of list of who you can contact for certain deal, and understand no need to talk to a Series C investor if you're a seed, and so forth. And then finally, we just gathered tech communities to facilitate adoption of more friendly regulation. So that being said, Valentin, the website, which is the first deliverable, I will introduce Valentin to talk about the details of it. So Valentin, over to you.
Good afternoon, everyone, and thank you for joining us for this first event of the collective, and that's really a pleasure to be part of it. So we've decided to create a website, firstly, to gather the resources that we are building together. So the standardized templates that have just been mentioned by Christophe. First of all, the term sheet template and guidances that have been developed by Julia, who's going to speak more about it later. But as well, the due diligence checklist that are still to come, but are going to be available over the next month. We've decided on this website to do more than that. Discussing with a lot of stakeholders, we realized that there is little information available about who are all the VCs and what are their main characteristics. So we've decided to create a list of VCs, and same for incubators and accelerators. The list of VCs is today more than 120 funds that are referenced in there. You can access the link down the page. It does not mean to be, does not aim to be exhaustive, but at least it's a good start, and it's probably one of the most comprehensive that you can find on the internet regarding investors focusing in Africa. And we are going to complete it along the way. And if you have any recommendation, that's a collective effort. So we really need you to push toward us. If you have a fund, if you know an investor, just reach us out on the website. As well, on the list of incubators and accelerators, that's going to be available from end of today on the website. That's a beginning. As you probably know, there are more than 150 incubators and accelerators across the continent. So that's more than 600, sorry. That's a big work to gather and to analyze what's the value proposition of each of them. But we want to do it, and we're going to do it with you. So please don't hesitate to fill this list with us. And the third part of this collective website are the curated reports. We figured out that there are a lot of very great resources about fintech, edtech, about financial services and other verticals, about investment, about how to strengthen your incubator, your accelerator, and many more from valuable sources. But most of the time, these documents are shared through WhatsApp groups, through LinkedIn pages and so on, and it's very complicated to find it all in a single space. So we've tried to gather it, and feel free again to share other valuable resources if you have some that will help the general community. Going further, I'm very happy to welcome Julia, who's done an amazing work in creating with all the partners. You can see the full version of the term sheet and the guidances. So welcome, Julia, and thank you.
Thanks, Valentin, and good afternoon, everyone. And a big thank you to Christophe, Valentin, and the team at the Collective for organizing such an important event. Thanks for having us. So, as Valentin had said, we are delighted to share with you this afternoon the work that Endeavor has done with the Collective to build a standardized term sheet guidance note. And really, the objective here is to support founders in their seed and Series A equity financing rounds. Valentina, if you can just hop onto my first slide, that would be great. Thanks. So this project has been really long in the making and was birthed out of the frustration that we saw in many of our discussions with founders who were raising capital and found themselves taking a huge amount of time out of their business to court and negotiate with investors, and would miss out on many opportunities to sell and to expand their businesses. And so really the aim after many of these discussions was for us to help them to reduce the friction of raising capital into their businesses. And for many of the founders on the continent, this is a really important part of growing and expanding their businesses into new markets. So it was opportune at the beginning of this year to really share this common vision with the collective and its partners. We've built this document, but we continue to test the assumptions in the term sheet with industry bodies like SAVCA and IVCA, with local and international VCs, and with entrepreneurs in our network and in many of the countries on the continent. And so today we are just excited to be in a position to share this document on many different platforms with many different collaborators, all working together to support access to capital on the continent. So you would have seen in my first slide, the document as it stands really consists of 3 parts. Firstly, there's the term sheet template, and that really consists of the most common terms that you are likely to see as an entrepreneur raising capital. It's then linked into a glossary of terms, which when we looked at many of the resources out there, we found that there wasn't an easy way to access a list of terms when raising capital. So we've got that glossary in there. And then we've got an Endeavour founder-friendly commentary section, which will help founders to really understand where the complexities lie and where the pitfalls can lie in some of these complex terms. So on my second slide, and then diving into a little bit more of the detail, this term sheet document, I think it's really important for us to note that it's not designed to solve all of the challenges that you may face as a founder when you're raising capital, but it's really designed to create, firstly, an awareness of the complexity of term sheets and the structures that you can find, the investor protections that are often present in many of these legal documents. And we hope that what that will achieve is to help founders avoid costly errors later on in their next funding rounds, when we can be so focused on just getting the money in the bank for this round, but we often don't think through the implications and unintended consequences of what it might mean later on. We also hope that this template will guide new and early stage fund managers around the terms that are appropriate at earlier stages. And again, in many of our discussions in our Endeavour Investor Network around the world, we've recognized how important it is not to hamstring entrepreneurs early on and make it really hard for funders to follow on in later rounds. So we hope that this will guide and provide a benchmark in earlier stages of funding. And then finally, to build trust with overseas investors. And we really want to land as much capital as we can on the continent. So I just want to note here that templates in general can be risky, but they are commonplace in many developed markets. If you are a company raising capital in the States, for instance, you can hop onto the NVCA website and download a number of documents from them. Similar in Europe with the Galleon project, many of you will know that Y Combinator has its SAFE documents online, freely available. And I see that 500 startups have launched their KISS documents for debt and equity raises. So this is really commonplace outside of our continent, and yet until this point, Africa really hasn't had a similar template. So we're really excited about the prospects of this for the future. In terms of next steps, at this stage, the document is focused on South African raises, just because that's where we are and it's proximate. But work is underway with the Endeavour Kenya and Nigeria offices and with IVCA to add sections that specifically relate to raising capital in other countries. We also plan to build out some of the more sophisticated terms that you may find in your Series B to E raises and across the world. And really here, the vision is that across the continent, across life stage, entrepreneurs and investors alike can use this set of documents as a benchmark and guide. So if we hop onto my last slide, we thought it might be helpful just to give you a practical look on how to use the template And some of the key challenges that have been raised are many years of talking to entrepreneurs as Endeavour as they've gone through their capital raises. So we really just encourage you to download the document. It is freely available, and as you work through it, you'll see some of these terms in the document. So essentially, the term sheet itself has a range of terms. Many of them will not appear in the term sheets that you get, or as investors in the term sheets that you deliver. We decided that we wanted to include as many terms as we could from all of the term sheets that we reviewed, just to, again, create that awareness rather than leave important terms out. You'll see that in many of the terms, we've recommended guardrails for input. So for instance, board voting rights may be delivered only to shareholders that have 10 or 15% of the equity, or we've recommended that liquidation preferences are 1x non-participating, for instance. You may find that investors come to you with very different terms, and of course, in every context, those terms are going to be negotiated differently. But we hope that just raising it with you as you go into those discussions will be really helpful. Words in green, just practically in the term sheet, link up to the glossary, give you more context as to the definition, and those with red flags are issued with a warning and can be found in our commentary documents. So on the slide, just to go through these briefly, many of the topics that we find come up often with our entrepreneurs raising this type of capital are things like balancing the protections for investors in delivering and securing that capital with founder control. And this is often related to in the protective provision clauses, where certain decisions that founders need to make as a management team are restricted, and shareholders need to get involved. And of course, this is a perfect illustration of where investors want as many protective provisions and to be involved in as much decision making as possible, and entrepreneurs really want as little involvement from investors. And we need to really help to walk that line well in building the relationship and trust between entrepreneurs and investors. Board seats and voting, what are the thresholds for equity to get a board seat? How should voting work? Of course, you don't want to give away too much of those rights before you land later stage investors. And the same applies to dilution of founder equity in earlier stages, another way that you can lose control of the company. The second point there, liquidity preferences and minimum IRR hurdles. We are seeing in earlier stage funding rounds that equity term sheets can look a little bit like debt term sheets with minimum return criteria. And in certain instances, that's fine, but you really need to be careful of some of those IRR flaws that can exist in things like drag-along or tag-along provisions. So ESOPs and option pools actually came up on a session we had with entrepreneurs yesterday. It's really topical because, of course, this is a way to attract and retain talent. The questions really, though, are around who pays for it. And so I won't dive into detail on that, but we have included a note around how to negotiate that at a term sheet stage. Founder vesting and founder protections. This is where investors ask that founders stay to build the business. Founder vesting can be incredibly dangerous for founders, but of course we understand why investors need protections. But as founders, we really encourage you to dive into this one and understand exactly what it means in an event where you need to leave in the next kind of 3 or 4 years from raising capital. And that also ties into things like good leaver, grey leaver, and bad leaver provisions. And really essentially here, you want to define as many of these clauses as you can and make it very clear. Because while we know that when relationships with investors are good, no one turns to term sheets, but when they do turn bad, or when the environment turns, it has a downturn, we can find that these are really important to have established at the beginning. So those I just want to leave you with. I know Mark is going to host the panel shortly, and it might be interesting to have some more commentary from our esteemed funders on the panel around these clauses. But I just want to end to say we are actively working on this document. We really believe in it to reduce the cost of friction for our entrepreneurs on the continent, and we would welcome any feedback and ideas for this term sheet. Endeavour is going to continue to update it and make it publicly available. So please do get in touch, and thank you very much for the opportunity to present this to you. Thanks, Valentin. So Mark, perhaps let's kick off with you then.
It's coming over to me now. Great. I was waiting for the intro from Valentin, but I'll carry on. I'm Mark Herson. I'm an investor and coach and an advisor at Endeavour South Africa. I love term sheets. I started my career 25 years ago as a lawyer, so I like words and commas and dots and all sorts of things. The term sheets can get quite hairy. And what's interesting to me is, I'm sure most of the people listening, watching, if you are entrepreneurs, will only deal with the term sheet, once or twice in your first time founder. So I think what's fantastic about having a templated term sheet is to be able to understand all the various potentials, terms and provisions and conditions that are out there. But obviously what's critical is to make sure that this is a living document, and what really is important is the nitty-gritty, the thresholds, the smaller protections that might be in the document. So without further ado, let me quickly say hi to everyone. First, we have Sharon, who I know from quite a while back. And Sharon is currently the founder at Recomed, which is a health tech marketplace. Then we have Angela. If you want to put on your video, Angela. Angela Muruguri. She's from Kawisafi Ventures, which is a $60 million equity growth fund focused on energy. We have Ross Genvy, who is the general partner and co-founder at Kingston Capital. They're currently in their raise of their second fund, which is they're aiming to get to $100 million. And then we have Vital Marchand. Is he on yet? Is Vital there? No, I don't see him, but he should be joining from Partech. Sharon, let's start with you. You want to sort of maybe take us through your journey. You can start with your first venture, or you could start with your current venture, Recomed, and just sort of give us a sense on what the value what the value is of potentially having this type of term sheet, if at all, and maybe just some of the stories that you've and experiences that you have along the way, raising capital to get to this point.
Thanks, Mark, and good afternoon, everyone. Well, I started out, for me, it was a very interesting journey in entrepreneurship, venture capital, and term sheets, because I actually started out fresh out of university. I studied computer science and electrical engineering, and less than a year and a half after I graduated, I raised venture capital. So it was all very new, and I think the way the lessons sort of progressed is you make more mistakes early and you try and make fewer and fewer of them as you go. And they tell me apparently that that's what experience is. So I can certainly reflect fondly now, 13 years, on a lot of interesting mistakes made. So yeah, the first company we raised about 30 million rand. We sold it in the US and merged it with the US company, which ended up raising maybe another 50 million rand or $2 million. Then came back to South Africa, thought I could start an incubator and be a small investor, and tried to give terms to other people. Hated being semi-involved in things, and that led to starting Recomed, health tech business. My parents are doctors, and we've raised about 30 to 40 million rand there, and all that's happened through a variety of different rounds, with a variety. All my ended up with a number of investors at the end. I think broadly commenting, I can get into various details. So I'll start by sharing some specifics and some stories. So very quickly, some horror stories in my life around terms is once I gave away, I'll tell you all the nice mistakes I've made in my career. I try to get things a bit more right these days. We gave away session of our code as security for an investment. That was an interesting lesson, one I don't recommend. We gave a high multiple liquidity pref once to an investor along the way. I don't recommend doing that. Permanent board seats to a minority investor who didn't want to relinquish them down the line. I think Julia commented on this 10 to 15%. That's very important. You don't want someone who puts in 100th of the capital having a permanent board seat forever. We once agreed to a dividend policy. That's very interesting for a high growth startup, probably something you don't want to agree to. And then interesting things with other exotic clauses like anti-dilution, ratchets, but it really, I think it's a series of tools, and it all depends on how it's implemented. And my advice to entrepreneurs is educate yourself on these tools. All this knowledge is out there. What the collective has put out there has some excellent commentary on it. But job number one is to educate yourself on these things, and then job number two is to talk to entrepreneurs who've been there and can tell you, that particular clause seems to make sense and it seems fine, but here's the unintended consequences of it. And it took me many years to understand unintended consequences because they take time to play out. I looked at the Digital Africa term sheets and I generally found them extremely reasonable. We can get into that, but I think the benefit, as I understand it, is one of demystifying what is seen to be a bit of a black box and complex and bespoke process for every fund, and everyone, the entrepreneurs without a broad diversity of experience get confused by this, and that's not good. That's the first thing. The second thing perhaps is, and some similarly new VC entrants into the ecosystem. The second thing is just increasing speed. And whenever founders raise money, at least 75% of the time, they need the money today, as I like to say. So if you can speed things up, that would be great.
And I think it's very much dependent on where the VCs are located. So part of the discussion we had yesterday was, I think if you're a South African startup, potentially you could wait a year from a VC to take their capital. If you're in the US at the moment, and term sheets are still, even in this environment, being closed in a few hours. So we live in a very specific type of market, and I think there's not as much price transparency. There's not as much transparency and uniformity on terms. But going to Angela, what would you say are the some of the mistakes that entrepreneurs have made prior to, let's say, Series A, firstly, and then maybe what are the mistakes that they could be making during their negotiation of the Series A document term sheet. And we have Valentin, is Ross and Mattel, are they on the call? I don't see them.
Yes, I'm on the. Ross is missing, if I'm correct.
So we've just got a connection from his Ross.
I think he should be joining.
So I have Mathieu. No.
Okay, great.
Thank you, everyone, and it's a pleasure to be here. To your first question, I think some of the mistakes we have seen, both as advisors and as investors across East Africa, is relying heavily. So this is pre-Series A, would be relying heavily on non-priced instruments. So a lot of the entrepreneurs at this point are looking at safes and looking at convertible notes, and then sort of pushing forward that larger discussion around valuation and control terms that they need to put into. I think in terms of how they manage that, it does become complicated when you sign these different instruments with different investors, and how to manage sort of that hierarchy of control, hierarchy of power, who gets what sort of return for what risk that they bore across the journey. So once they try to get into a price round, it becomes slightly difficult how all that will be managed when you have all these people around. I think post within Series A negotiations, I think some of the challenges or mistakes that entrepreneurs make is that they don't look at the whole term sheet as one deal. A lot of focus is given on valuation and on pricing, and very little focus is given on some of the other sort of protective provisions, or even basic terms, as Sharon mentioned, around liquidation preferences. So what's happening is that there's this, as you say, education on the founder side to look at the entire term sheet as a deal and understand what sort of some of the compromises mean and what exactly that means, even to future rounds as they try to go into their Series B and Series C, because some of that does set a precedent that becomes harder to negotiate as you bring more institutional capital on board.
Thanks. Matteo, on your side, just to continue from Angela's thought, is it are convertible notes and safes a bad thing for entrepreneurs in the pre-Series A, in your view? Looks like Matteo's lost his internet connection. Julia, do you want to maybe have a shot at trying to answer that?
Yeah, so Mark,
Okay,
I mean, we're seeing more and more the demand for safes and convertibles increasing, and of course we understand why, because it means that particularly from a valuation perspective, founders don't need to be caught up in long negotiations. You can raise a bridge round essentially, and that will convert then into a Series A. It does become a problem when your Series A gets pushed out, and you can find that the conversion maths gets very complex. So again, really important to get to grips with what it means for dilution when you do raise your Series A, and what some of the protections around the safes mean. And there are really divided views around whether it's a helpful tool for companies to raise, particularly early on. But the one thing that we can't deny is that it is certainly becoming more attractive, and Y Combinator has really led the charge on making this an instrument that is easy to understand and easy for founders to secure as they move towards their Series A. One thing I will also say is that where companies are needing the capital to scale their business model and are not going to get the valuations that they require because they need to build that track record, safes and convertibles can be very important to not dilute drastically until the company gets to a point where they can get the multiple that they're looking for. Matthew, you might well have better advice and more sage advice on this one.
I'm not sure I have better advice, but I guess maybe just completing what you all said is that first, I totally do agree with Shiran, which is that it's key to educate yourself as a founder and to make sure that indeed you really do understand all the terms, because as Julia was saying at the beginning, like as long as everything goes well, it's always like a good story and you don't have any problem and nobody's coming back to the shareholder agreement to check who has which rights. But once, I don't know, you have a disagreement, because it can happen. I mean, it's like a marriage. You have a divorce, unfortunately. And at some point, like in 5 years or 10 years, you have some investors that want to have their money back because they have to return the funds to their own LPs. Or as a founder, actually, you want to exit the business because it's a time of your life where you want to do something else. And investors want some kind of return. And you don't want to get screwed neither way. So it's good to make sure that everybody from day one has good understanding of what's the deal and what are the terms that we're all putting on the table, and who has what kind of rights, and how do you balance all of that, so that it's always a balance of power, and you don't give too much power to investors, but you don't give also all the power to the entrepreneur, because of course shareholders and investors are giving you capital, so you have to protect that capital and do the best to make a good return out of that. And so this balance of power is, I guess, really important for me, and I guess it's also linked to kind of sorry, one sec. Can you hear me? Okay, sorry. And that you have that balance. The more investors you're going to have around the table, the more risk you have of having, one guy that has this kind of veto right on something, and then you have given something else to someone else. And then as an entrepreneur, you end up with a lot of people around the table that do not have exactly the same interests because they entered at different share price, or they entered at different moment with different fund strategy. And you want to make sure that you align everybody so that you don't have on each decision someone that can say no to you. You want to make sure that actually the collective intelligence of people that are around the table, the collective intelligence of your board, is the one that will be used to take the decision. And even if like there's one person that do not agree with the collective intelligence at that point because it's not exactly in the same, their own interest, they can see that actually it's the best for the company. And that's what you need to build when building your shareholder agreement, the structure and the legal structure that ensures that the decision-making in the company will be done in a clever way and not based on someone's interest because they have another agenda.
Mm. Sharon, how do you get the right, well, whether you call it balance of power or you call it, negotiating, bargaining power as an entrepreneur? How do you get that?
There's a few.
No, very well talking about the terms, but
Yeah,
it comes down to power. You and I had that experience many years ago.
And I've had it. I'm sure we've had it in different rooms many years since, Mark. And I'll say this: Mark and I have an interesting story from 2011. But it was fascinating as a case study because Mark did a deal that saved my company. He probably doesn't want me to share too much about it, but he did a deal that saved he did a deal that saved my company. But here's the rub on it: at the time, and many startups go through ups and downs, the company wasn't doing well, so it was a hard deal. And this comes into the complexities of, and of course later we shot the lights out a couple of years later, and then things change, and this is the nature of the journey. So I know let me answer this question in two levels, Mark. And I'll get back to that story because the truth is sometimes it just gets very complicated. But initially, I believe in simplicity where possible. So I feel that the simpler the structure that gives everyone the minimum tooling they need to get the rights that they need is probably best for the entrepreneur. I say this, but I believe, and having been a small investor as well, I do believe in things like lever clauses, etc. The founder has to show that they have a committed interest in the business, and that there's not going to be any. They're not going to up and leave because there's a lot on the line, and that's a big concern of mine in general when dealing with founders and entrepreneurs. So there's got to be a meeting of a partnership there, and that partnership needs to have lock-in agreements together. I think the converse of that, just some simple principles. So one principle that I try to advocate for is, where possible, on the side of simplicity, and you increase the complexity as fundraising rounds occur, because what tends to happen is there tends to be an inflation in terms. So if you throw everything in the kitchen sink in your first seed round for $150,000, when you're out there raising $5 million, the terms may look significantly more complex, because what typically happens is the next investor, you're building a staircase or a ladder of several deals on your way to an exit. And depending on how many bridges, we're talking 3 major rounds and who knows how many in between, maybe 10 rounds of funding in a business's life cycle, if there's bridges as well. And every successive group of investors will want access to the previous group's terms. So you can end up with this terms and rights inflation. It gets complicated, which is why it's very easy to poison pill your company in the beginning. So my rules are simple. Just don't agree to bad terms to get a deal done in the beginning. It has massively negative consequences later on, to the extent where you end up with a company that a Series A investor may not be able to invest in, or they have to do a massive complex, time consuming, and a lot of the investors with good deal flow won't bother with that. So the first thing is you just have to dig your heels in and say no. And when I've been forced to do that, I've been able to illustrate for the investor, drawing on my own personal experience. I'll say, look, we did this once, and here's what happened later. When we tried to sell the company, here's what happened. When we had to get a foreign investor, this is what happened. And I think I really think it's possible to create terms that are very favorable to the investor and the entrepreneur and that are fair. And that philosophy, the reason why you want to communicate that to your investors as the founder and say, you know, a 1x liquidity pref's fair, but a 2 or a 3 doesn't make any sense. For example, that could be one at a Series A level, or you could say, you know, this particular instrument of you having a permanent board seat and you having a permanent right to veto any significant decision in the business doesn't make sense. Those are two common examples. How do we deal with it? You say, well, if they're on the journey with you, at some point it is very conceivable that fund will be exhausted. They participated in 2 or 3 rounds and they're all invested in, and you're going to have to bring on new partners. And then those investors are very likely going to be in the foxhole with the entrepreneur dealing with the new parties, and having some symmetry in the terms makes sense. So in that case, you might say, but you might explain to the investor, if we have X amount of rights together, then we have significant control in the business, and we've created a healthy precedent in how we handle decision making. I just thought that was a very important point, and one that people often forget. So I dig my heels in, but I communicate to the investors of why it's best for all of us. And often the best way to do that is to use examples, and then to also explain that the journey is going to be a long one. These are the rounds you expect. And I find investors are often, when you put it to them that way, they're often quite open to say, yeah, you know, you make a fair point. We're probably only going to participate in the next round, but after that, things might change, and we have to structure ourselves to be investable later. And any incoming investor's dream is having a simple company to invest in, not a complex Christmas tree kind of company. That's not what they want. So I advocated in the investor's self-interest, and I just try and keep things fair.
That's a really good point. Maybe we can go back to just a little bit later to the exact, if you're open to sharing the exact terms that
Sure.
What happened with us.
Yeah, we need to go back to that story. That's a higher grade case study, but that'll be good.
But Angela, what do you? So just sort of, I mean, what Sharon's saying echoes really, you know, your point around the safes and the convertible notes, potentially complicating things. But I suppose again, it goes to, you know, what else is in those terms? You know, what are the terms that are in those instruments? What would be 1 or 2 examples of like a really bad mistake in a current Series A, maybe in the last couple of months or in the last year or so that you've seen, you know, an entrepreneur doing, you know, that might just sort of say, well, this is not the type of entrepreneur I want to deal with.
Yeah. I think there does tend to be a lot of tension around founder matters. I think one of the most common terms that you'll see is either a vesting or a lockup. I think in East Africa, lockups are a lot more understood, and vesting is sort of catching up, especially as businesses go down bigger rounds and future raises. But I think I've seen entrepreneurs giving signals that suggest that they're likely to want to exit in maybe 2 or 3 years, or a similar investment horizon such as yours. And I think that is one of the things that does put investors off. If there's no full confidence in the founder or the management team being able to hang in there for the long term, or until your, I guess, investment horizon is over. So I've seen entrepreneurs request early payments. I've seen entrepreneurs really struggle to understand that they cannot sell their shares. And I think it's just that signaling. I think, as Sharon said, you want to be on the same page, and you want to know that everybody's working for the best of the company. And some of those sort of founder matters do come up as tricky negotiations.
So just staying on the vesting and the lockup provisions, just for the VCs that are on the call, and maybe, you know, what do you see as standard now? You know, like things that would be almost non-negotiable. You know, what would be the minimum requirement on a vesting for a founder or a lock-in?
Yeah, so I think what I see is a 4-year vesting, 4-year lockup period, especially for a Series A where the assumption is that this has not been done before. I think the vesting specifically comes in where, you know, founders have been through one lockup, you're negotiating sort of a second round of lockup, and you do need to give some sort of incentive to vest over that period, as opposed to going into a second sort of really structured lockup for another 4 years. But I'd say the first few negotiations, it would be fairly standard for a 4-year lockup, and post the initial lockup to have maybe a 25% cliff, and have post that 25% another sort of graduated scale to full vesting. That's what I see. That's what I would
Mathieu? On your side?
On my end, in terms of, yeah, first I totally agree with this kind of standard clauses. One thing that indeed creates for me some issues is indeed the secondary transaction when it comes along with a primary transaction, especially at early stage. Most of the time, as when you invest at Series A or even like seed, we see some seed founders trying to get some cash out, and we see some Series A founders trying to get some cash out. And I guess on our side, indeed, that's creating an issue, because indeed you're at the beginning. You're supposed at least to be at the beginning of the journey. And if it's not the beginning of the journey, if it's the end of the journey for you, it's not a problem at all. But then you should not be trying to raise funds, or you should come with a very structured way to explain how the company will grow without you being so much involved. The second issue that we have sometimes is the valuation and the link between the valuation and the other terms. So we see founders that are very sensitive to the valuation that is put on paper. The truth is, like as mentioned, you can have participation clause, you can have preference clauses, you can have a lot of clauses that are actually balancing the valuation. And the problem is when you're saying, okay, that's the minimum valuation that I want to have, the tendency that I see is that as an investor, you tend to say, okay, if I like the company still, what I need to do is take something else to be able to compensate that. And then you're creating term sheets and shareholder agreements that are not simple, not straightforward, and that will create issues down the line. And that's something we do not like. And so we spend a lot of time explaining, okay, so one solution is the simple solution, which is this is the valuation we're ready to pay. And that's, and then you negotiate the valuation and you keep very simple terms, or you increase the valuation, but this is not, it's kind of artificial. And then you have other terms to balance that. And I really try to avoid that as much as I can. And the truth is you're starting to have this kind of negotiation with the entrepreneurs. And at the end, most of the time you end up just not doing the deal because you feel like, okay, we're going into too much complex terms for a deal that should be simple. And actually the term sheet and the simplicity of the term sheet is often a reflection of the simplicity and a healthy relationship. If the term sheet is simple, it's because you have a healthy and simple relationship with the funders. And that's really important because that's a reflection of what's going to be the journey in the next 10 years for the two parties.
Mm-hmm. Just I am curious to, I agree with that, and I like this whole simplicity angle is critical. But it would be interesting to hear an example of where you have increased the value, gone into a deal where the valuation is maybe a little bit too steamy, that you've had some sort of other accommodating clauses. Like what examples would those be?
So you can do it both ways. One deal that I did back in days was actually you were so giving back shares to the founders above a certain threshold. So like above 5x of return, you'd be giving back shares. So this is the case of, okay, we're not going to the valuation the founder wants, and the founder is telling you that he can give you a 10x return on your investment. And so you're saying, okay, you know what, actually, if you do me a 10x return, I'm more than happy to give you back shares so that it compensates for the valuation that you have lost at this stage. So we've done one deal like that. On the other way, we did put some participating for a company, saying that actually it will fade away above a certain revenue threshold, which is the revenue level at which we believe actually we will have done, no matter what, a good return because the company will have grown so much that we're happy. Because again, the idea is never to, for instance, on our side, at least Partech, we're never going above 1x preferred, and we're never doing participating, unless indeed there's like some kind of things where actually we use that more as an incentive for the founders to go where we want the whole company to go, and then we say, okay, so that's fading away.
Julia, those, how would you comment on those sorts of terms? I don't think are in the template.
No, I mean, that's so wonderful to hear.
But we actually have.
We do have some of them. I mean, I think that there's the terms that you're going to find in a standard Series A equity round, and then they're going to be very different terms as you progress into more mezzanine instruments, safes, convertibles, etc. And I really like the suggestion of giving back some of the founders some of their equity that they may have lost in earlier funding rounds if they can achieve certain targets. Many of these terms we have included in the term sheet, but are always looking for additional terms to add in. If there are those that we see, and particularly Matthew, if you're happy to share those, we'd love to include those just for an awareness perspective for entrepreneurs.
Sure. Yeah, in fact, I think one of the Endeavor companies that we were both involved with recently had an adjustment of their valuation, and I think that was, coming, and they were fight to be able to pull back those shares based on some performance down the line, and that type of share, structure was put in there. But I also am not a big fan of that, of increasing the complexity. So rather than get everyone happy from day one, but often that's not the case, and it's not possible.
I always as well prefer, in my experience, it's really been preferable for, as the entrepreneur, to ask the investor, please price whatever risk you think this deal has into the offer you are willing to make. And the best kind of deal, in my opinion, you can make is a straight equity deal, because it's fully priced. It's not pushing the idea of valuing the company at some unforeseen date in the future. And sometimes entrepreneurs can collect convertible notes like stamps, and when the time comes to cash it all in, nobody knows what their cap table actually looks like, and the founders and investors can end up in a difficult position. So while I understand the utility, my favorite kind of round is a price straight equity round, and a single price, not where often you get this concept of a ratchet, where if the company hits X revenue milestone, the investor gives the founders 10% of equity back, and if they miss it, they take another 10%. So they could end up getting 20% on the low end or 40% on the high end of equity in the startup, for example. I have seen a case in a company I advised where the entrepreneur was so ambitious and persistent in pushing that they can achieve certain targets, to Matthias's point. And they ended up taking this kind of scenario structure, and they felt very confident that they would hit the upside scenario. So it doesn't always come from the investor playing risk tolerance. It usually does, but not always. Sometimes I think entrepreneurs push too hard, and that's why, for me personally, I always take cleaner, fairer rights over a higher valuation, because poor rights and poor structures will end up having a big price down the line to everyone's outcomes anyway, and it just makes it a really difficult company to run. To the example we talked about, something where we got an example where the investor might get between 20 and 40%, it can even create perverse incentives depending on the control structures and the timeline. So it's one that's my thought on that. And the other concept that I thought might be helpful is, when investors insist on having certain rights, board representation, for example, even though they're under 10% in equity, another could be they want rights to future funding, for example. That's another one where they say, well, we want rights of refusal, we want the right to put more money in the business. It's very common that you see that. And when the investors are unwilling to let those rights go, and those were not in the term sheet that's been proposed to my great satisfaction, but if they are insistent, and we can understand where they come from. They're putting in money, they're taking perhaps all the risk in that particular round potentially, and they want some level of control, and perhaps they're giving the entrepreneur very favorable valuations. They just want their share of the control and their share to put their right to put some more money in the business. So what I've done, which has worked, is if you ask the investor why they're doing that, what's their rationale, and you try and understand it, you'll find it's often that they want to be stewards of their capital, responsible stewards of their capital, and so on, and they want the ability that's in the case of the rights. And for the future funding, they want the ability to invest more if this early investment has been successful and so on, which are reasonable requests. So what we do there is, instead of leaving them as permanent, and that's the way they leave them open-ended and permanent in the term sheets, I always find no one ever has a problem with ring fencing these structures. And if they say, because you say, oh, okay, so you want a board seat. Well, how about a board seat for 12 months? You only own 5% of the business. How about 12 months? And then we go back to a normal voting structure. And then it creates a conversation, but we're not talking about forever. And similarly, for funding, you can say, well, how much funding would you look to deploy in the business? Okay, you're looking to deploy $2 million and you've only put $1 million in. What if we give you perhaps a participation right to put another $1 million in on the terms of a future round or something like that? These are all if it's contingent to doing the deal, but when you leave these rights open-ended and you don't ring fence them, it always has unintended consequences years down the line.
Yeah, and Mark, I was also going to add, Sharon, that's such a great point. What I was also going to add is I'm seeing more and more, and we all will be, with the COVID environment, that investors' risk appetite is changing rapidly, and you can see valuations start to hike and terms start to tighten because of risk appetite within those investors. And I think what's really important is for founders to understand how that investor is self-funded, and what is important to that investor to achieve from a return and risk perspective. And sometimes it's actually a price discussion, but it starts to become a terms discussion. And so to separate those two things out, to say, okay, hold a sec, is this actually a valuations thing that we need to sort out? Or is this really a terms thing, rather than bunch those two things together? Because in a more and more risky environment, you can find that investors are slowly backing out. And you really want to test that in the relationship before you accept any of the tightening of terms or increasing of valuations.
Yeah, that's a good point. So going back to your director board representation, seems like on this call, the sort of a minimum threshold would be seem to be suggesting 10% would be. Are there instances where it should be higher or lower, or not? Shouldn't be a threshold at all? What's the general sort of sense out there at the moment?
On my end, I'm in favor indeed of the roughly 10%. Of course, it's not like a number that is absolute. And of course, if you have a great early stage investor representing seed investors that has like at the end 7%, and I mean, it can make sense to keep him on the board, of course, and it's very valuable. But the idea is roughly by 10-15%, at Bartek, we're doing roughly by 10-15% part of the cap table. We're giving one board member. The idea is to keep the board as small as possible. You don't want to have 15 people being sitting around the table at the end, because it's hard to manage. So yes, roughly 10-15% seems reasonable to me, at least.
I always advise entrepreneurs to make it 20% and force the investor to give a very good reason on why they want to lower that, because I'd say that in South Africa, at least, the VC standard would be 10, which means you could end up with 7 board members if 7 is your max. I'd prefer, max of 5. Ideally, you want 3 or 4 directors and 20%, but I'd say the standard is 10 in SA. And then if they don't, so you put 20% in your MOI, and then when the investor argues for a lower threshold, give them a timeline, give them 2 years on the board, and don't change the MOI. And I find that works out more founder friendly in the long run.
Angela?
I agree. I think that does seem to be what's generally acceptable as a standard. I think the conversations we have is because this early stage discussions tend to be quite relationship based. And as you go through these discussions, you tend to understand what each board member is bringing to the table. So composition also becomes important. So I think that is the standard, but there are conversations going around what are the most important skills required on the board, and therefore who should. And if you're on the same page with the entrepreneur, it becomes a lot easier to discuss whether, seed investors who do fall below the thresholds should remain. What that evolution would look like as more institutional.
Okay, great. And then on the board itself, just quickly, I want to just finalize on the board side. Should board voting be, is it, one board member, one vote, or according to your shareholding? So take the scenario where you might have, which one that I'm currently seeing at the moment, where you might have a shareholder investor that's coming in who has about 20%. So he's saying he wants one board member, and you have a founder that has over 50%. Clearly the founder should be controlling the business. Just notwithstanding some, protections. But what do you say? Do you say we vote according to our shareholding, or we vote according to the number of directors we have?
Yeah, so not to make this extremely complex, but what we tend to have is we will have reserved matters that are based on preference shareholding, and we'll have reserved matters that are just purely for the board. I think matters that are purely for the board, if you have a board that makes sense to have, in terms of composition, an easy majority vote, then I think that should be the way it should be done. I think in cases where there is that layered provision that there are some decisions that are basically going to depend on the thresholds on preference shares and your actual ownership, then that should be how that's handled. But I think for day-to-day, to try and make it as easy as possible, if your board composition numbers do allow you to have a simple board structure and simple voting decisions.
Any disagreement?
Yeah, I disagree somewhat. I just think, look, a public company has shareholders that have an AGM where they elect their directors. Directors serve at the pleasure of the shareholders, but they serve in the best interests of the business, and they vote in a majority fashion. And why should it be any different in startups? So to answer your question, Mark, if the founder has one seat, he has one vote. But if the investor is voting against the founder can use his shares to nominate a friendly director who will vote alongside him.
Okay.
I mean, I guess
essentially that according to the significance of your or materiality of your shareholding. For sure. Okay. On the minority protections, what are the? I mean, there can be 100 of them. There can be 10 of them. How do entrepreneurs not get swept away? And what's the advice to an entrepreneur? I mean, I'm going to start with a VC. To ensure that they retain control of the operational control of the business. These minority protections. I mean, I've been on the VC side and I've put in some quite scary ones. Hopefully, I'm back in the day. But what's your advice? What should they be fighting for and not fighting for? Maybe start with Mature, just a few minutes, and then Angela, and then I'll ask Julia to get in, and then Ron, you can come in last.
Maybe there I would mention tag along, drag along clauses. I mean, again, in terms of making sure that everybody is that nobody is able to prevent a sale of the company if the terms are reasonable and make sense. And of course you can put some threshold there. So as a minority investor, as an investor, you can say, okay, I want to have a veto right if actually the exit is below 2x my return, or to be discussed, of course, 1x my return, 3x, depending on the investors. But you should not be able to prevent the sale of the company if, again, a majority of the shareholders believe that it's a good exit. And if the founders agree also. And I guess second point for me is, it's not really, it's a bit linked to the question, but actually I do believe that you will never be able to sell a company without the founder's consent. no matter what. And actually, 90% of the value is linked to the founders being there and running the business. So you have a lot of clauses that are being pushed by the lawyers also. and Mark, you'll tell me what you think of that. But sometimes, for the sake of
lawyers should stay as far away as possible.
And I like to have my lawyers, advising me to say, okay, we'll put a lot of protection for you as an investor. It's great, but de facto, actually, I do believe that in many cases, actually, I have like protections that I will never be able to use, because should I use them, actually, like if the founder is just coming back to me and saying, actually, I will not do that. I will not go and work for this company that you want to sell, or no matter what, it has no. At the end of the day, as an investor, I don't have much power. And I've seen a lot of cases, which is quite interesting, where actually, you have all those preferences and all of that. The story doesn't go in the right direction, and you have to sell for a low price that is below the preferences. And so, in the principle, at least the founder should not get anything out of that sale. And as a founder, my big advice to you is like, you go back to your investor and say, you know what, give me 10%, or I'm not selling anything. And just renegotiating everything, because of course, you're the one that will sell the company, and you're the ones that, the next buyer will buy, not the investors. So if the investors have some money in, want actually to get back some of their shares, when it's like the bad case scenario, I would strongly advise you always renegotiate, and that's life. And I mean, as an investor, I do take that into consideration, knowing that I have a preference, but down the line, I expect my founders to come back to me, and if it's not going well, just to renegotiate also the terms, and it's normal.
So drag along or come along and tag along clauses. My personal view is I don't think there should be any minimum return on those. I think that's, if I was the entrepreneur, I'd fight very hard to avoid those. But let's hear, I'd be interested to hear your next, who did we say? Angela's view.
Yeah, no, I think the entrepreneur should be anything that sort of touches on the strategic direction of the business, and how much of that they have to go and get sort of approval for. So based on sort of geographies of working, or the leverage levels that the company can take, I think there should be a very agreed position on some of those matters, because they do tend to increase the bureaucracy and sort of reduce the amount of flexibility that a business might be able to take on.
Julia?
So, I mean, I completely agree. I think just from a practical perspective, it's helpful to just define who protections will apply to. They certainly shouldn't apply to anyone who has any tiny stake in the business, because to Angela's point, you want this business to run, you want it to fly, and you can weigh it down with lots of protective provisions for shareholders you can't get hold of, or important at the beginning, but really are silent partners and shouldn't have a say in the business. Then the second part is, I think it's helpful to stratify which types of decisions are important to get investor approval. And of course, there are those like, starting the business, changing the main purpose of the business, etc., that you'll need shareholder and investor approval for. But there are many of these decisions that need to be that the management teams really need to be released to have the power to make these decisions, and get the business to kind of create the right cadence to create value for everyone. So I don't think it's in everyone's best interests to weigh the company down with these minority protections. So just practically, I think really important to spell that out. And it often depends on your leverage, right? It depends on how many investors you have, how much leverage you have in the negotiation. But there are many of these levers that you can pull. And I think as founders, you need to really understand for your company, what are the critical ones that are a walkaway point for you, and which are the ones that you're happy to engage with investors over the next 5-10 years.
So you said if you're a founder, you'd be very against you'd be very against come along, drag along, and be very cautious around that. And I'm interested in your view there. Me, I know I've always held up the founder friend.
Before you go into that, so I'm against it when there's a minimum return requirement. So which I think is so. Matthieu, I think if you were saying correctly, and I was a bit distracted, but I think you were saying there might be a minimum return requirement on a come along. Yes. So I've seen one in a recent document which said, come along, under the normal circumstances, provided, we get our 30% IRR. So that's what I was referencing.
Oh, I see. Oh, that makes sense. That makes sense because I'm not against those clauses as a founder. For me, I think drag and come along is very standard as long as the percentages are reasonable, because it's more likely you're going to have a difficult minority shareholder than the founder not being able to create material support among the shareholder base that ultimately they've put together. So I agree.
Yeah. So, my point on that is saying, if you're a VC investor and you're coming on board, you're really backing the entrepreneur. So, if there's going to be a good sale that comes on board and, you agree on the right threshold for who's got majority in the company to drag, those shareholders along, why should, a minimum return prevent the sale from happening? It's an absolute veto on the sale of the company, and it might be a very reasonable offer. So, yeah, no, it's not in all instances, but would be good to maybe Matthieu give you a chance to chat again, reply on that.
I totally understand. I guess we were pushing that more as, on our side, we're putting that in our term sheet to be quite transparent. We do not put anything in terms of IRR, but more like absolute return. And most of the time, it's like, we're investing in aiming to have a certain return. The goal is not to say below 5x, you cannot sell. It's more like, okay, below 2x, actually, you need to have our validation. Just because the risk that you're taking, especially when your later stage, is that we see is that you have seed investors and the management potentially that have already done a pretty good return on the investment, and you're coming because you believe, and actually people are selling you the fact that the business will go to 50 million value or 100 million value, whatever. And so this is the plan that you're buying, and this is what you're coming for. If the goal is to sell the company at 2x, you wouldn't be coming. And so in the discussion, most of the time we say, okay, so we all agree that this is where we're going. And if it's not the case, and because life will be different and more difficult, we just say that under a certain minimum threshold, you need to have a validation to be able to sell the company. Of course, it can be discussed because I totally also understand that from an entrepreneur view, it's a restriction on its ability to sell the company at a lower threshold. And the idea is just that you need to have reasonable partners around the table. I've never seen a case at Partech where we have said no. Actually, it's more like, okay, we just need to have a discussion altogether on why actually it's good to sell the company now. And you cannot just come to us and say, we're selling the company, you have no choice. So it's just also a way to make sure that we are engaging the discussion. Because again, if the founder wants to sell the company now, it's better to sell it now. You cannot oblige him to say, stay in the company he's not happy in or he wants to sell.
Yeah. One last thing, and then I see Valentine's probably wanting to take over, but that has come up many times, especially with the 30 or so endeavor entrepreneurs and the discussions with Julia, is around, what's the expectation of the minimum equity, percentage equity that founders should have in a company when they come in pre the Series A, and so that it looks meaningful enough and it feels meaningful enough to for it still to be their business, and what would that percentage look like post Series A, fully diluted?
I would say 70% ownership pre-Series A or above, and above 50% at least post-Series A. For me, post-Series A, you still own the majority of your business most of the time, again, depending if you've been raising a lot of cash or if you're in a more capital-intensive business, but I like the idea of having founders who are backing, owning the majority of their business post-Series A. And
okay, 70% and then 50%. Okay, great. Angela?
I would say I'm not as committed in the pre-Series A. 50% at Series A sounds about right.
Post-Series A or pre?
Post.
Post. Okay. Sharon?
I think given I think there's a big variety here, and funders have been pretty flexible in examining this question, because sometimes a lot of dilutive fundraising has to be raised before a Series A, depending on the nature of the company. So what I would say is, yes, absolutely, founder control is critical. But if I found in some cases where investors can't get to that level, they need a deal structure where they feel the founder has commensurate incentive to build the business and not become, every founder will become fatigued, but not become so fatigued that they don't understand what's in it for them. And it's a very mature thing, but I think the whole ecosystem has gathered around it now. So you could see things like ESOPs and options, etc., being granted to founders now, and I've seen some of those things come through when they're not over 50%. But you know, if something like that can't be worked out and founders are heavily diluted, then often you end up with deals that funds are just not willing to do, and that speaks back to why it's important to get your funding right early on.
Julia, seeing that I'm a colleague of yours at Endeavour, I'm giving you the last.
I'm always allergic to founders over diluting in early stages, but I do take a point around it's sometimes necessary. I have recently seen investors turn down kind of Series B rounds because founders are enough incentive for them to build a business. And I think at a Series A level, you really need to be cognizant of the dilution that's going to come in follow-on rounds. So I would like to see kind of more like a 30 or 40% max dilution after Series A, because I think that puts the founder in a wonderful driving seat and gives it a little bit of extra headroom. But I also appreciate that's not always easy to do, but that's what I would aim for. Mark, you're on mute.
Yeah, thanks to everyone on the panel. It's been great. It's been a lot of very transparent answers. So thanks very much.
Thank you very much, Mark, and thank you to all the panelists. It has been a very insightful conversation to have all your vision and feedback, and that we've got an amazing engagement from the audience as well with so many questions, and I think they really appreciated that you've been very transparent and cash on the ways you're practicing or the way you faced it as entrepreneurs in the past. So big thank you to all of you, and especially you, Mark, for animating this session, and Julia for leading this awesome work on the term sheet. I'm going to go back a bit on the slide just as a reminder on how you can engage and how to continue the discussion. But thank you all the panelists. Just a sec, it's reconnecting. Perfect. So you can normally see my screen now. Can you confirm that you're seeing my screen? Anyone?
I'm not seeing it, Valentin.
Sorry about. Going to be added over the coming days and weeks. You can already find the term sheet template. I've posted the link a bit earlier in the conversation. So just have a look at it and don't hesitate to come back to us. There is a possibility to reach us out on the main page of the website. So just send a message and that's going to be shared with all the collective so we can improve and think about your different comments. The due diligence checklist is planned to arrive end of the summer, so probably beginning of September, and we're going to organize a new session to talk about that with another great bunch of speakers, investors and entrepreneurs. This due diligence checklist and how to align the requirements when investing or receiving investment into your company. You can find from now on the website a list of VCs. So as we said, and I've seen with some of you have been looking at it already, there are approximately, most of them with the details, but not all of them. But we're going to work hard again. I need to make it more comprehensive over the last weeks and months, next week and month. And don't hesitate if you have a fund that we don't know to just reach us out so we can add it. From tonight, you will be able to access a list of incubators and accelerators as well on this financing your venture page on the collective website. So feel free to enrich it. It's very basic, but that's something that is missing at the moment in the African tech ecosystem to understand who are the incubators, who are the accelerators, what kind of value and specifications they have. So really, if you can help us on that, that's going to be an awesome work that you can get done over the next month. And you can already find some curated reports, so sectorial insights on various verticals, investment reports, and reports on tech hubs building, how to improve and strengthen your capacity building as an accelerator and incubator. If you've produced some resources, and I've seen that you've got some great organization, don't hesitate to share with us as well. Either contact me directly by email or just on the website to send us a message. Just to raise a point that has been asked a bit before about what are we doing to help Black founders raise more funding in Africa, because that's an important point. So we don't have a fund, as we replied before, or the Digital Collective Africa does not aim to become a fund, but what we try to do is to give the same chances to everybody by indicating you who are the VCs, what are they looking for, how to deal with them, how to make your company more pretty. We aim to gather educational resources on how to grow your startups, increase your growth and so on over the future, so we can make sure that everybody have the same level of information and resources at their disposal. And we really look forward to have your resources to do that, as it's a collective effort. And even though we are a large number of organizations from different parts of the continent, it's not going to be enough. So please send us a message if you would like to be involved, and so we can start the discussion. So thank you very much. Please go on the website. That was wonderful to have you. And again, thank you to all the panelists, Julia especially, and Mark as well for this great moderation. Have a good day.